text bracket, but okay, it's fine. I'm already in.
Hello there. I can see you.
Hi, Claudine.
Okay, we have a few minutes. I pasted the attendance register in for you already in the chat, and I started the recording.
Okay, that's fine.
So, I'll give you wait till 4. They will just introduce you.
Okay, that's fine. That's fine.
I got here. Oh, there's something wrong with my setting.
Can you hear me? Hi, Claudine. Yes, I could hear you. Let me just check quickly.
Hi, good afternoon, everybody. My name is Claudine. I'm from the Western Cape Facilitation of Learning team. Your tutor for today is Mr. Oliphant. Sorry about the delay in the start of the tutorial, but we had a few challenges. However, it wasn't on our side, but we don't speak about that. We just blame everything on COVID. Any delay, you can blame on COVID. So now, I'm not going to take up of your time. I know you want to just start with your lesson. Mr. Oliver says it's fine if you call him X. So that's how we all refer to him. And I've started just some admin. All lessons are recorded because you can have access to it. If you have a problem with that, then unfortunately that is the rule. And then if you go to the beginning of the chat, but I can repaste, if you scroll up in the chat bar, you will see I pasted a link. There's an electronic attendance register now. You just click on that link. It's 3 questions, student number. The area actually where we ask where you come from, it's just Cape Town or George or other. Those are the 3 options. And then your module code, and that will allow us electronic then you don't have to type in student numbers anywhere else. We will save the attendance will be saved automatically. And then I just put some admin down for you that you can join the MyUnisa portal, the Western Cape site. Just a link for you that you can also go back to in your own time. And then near to the end of the session, I will post an evaluation form. But for now, I'm just going to hand you over because the time, I know you all want, you waiting on the man himself. So that's my part. Every week, I'll just put in the admin stuff. You can just go click on the links while you, but I know most people in this class do it afterwards. But for those of you that join before the time, I'll always paste it a few minutes before the time. Thank you.
Okay, thanks, Claudine, for the introduction. I hope you guys can hear me. As Claudine have introduced me, I'm fine. You guys using calling me X, whoever you prefer. My name is Polani. Oliphant is the surname. So I've been now with UNISA for, I think this year is my 4th year. So I think with the admin aspect is that, so if you log in with a guest, as a guest, the information that Claudine was referring to as far as the attendance register, if you've logged in after she's pasted those stuff, so what's going to happen is that on the chat box, you'll only see from when you've logged in or logged on. So you're not going to be able to see the previous chat. So what perhaps Claudine will do for us during the session is that perhaps repaste again the attendance register and then as well as the feedback form, and then as well as any other links where you will require the information. Yeah, so because if you log in as a guest, like in my case, I'm now as a guest, so I can't, I'm not privy to what those links are, but I know them by now because I have them on the site. Yeah. So I think today what we'll do is I've given out a sort of a register to say what it is that we'll do and then when we'll do that, right? And then also the topics that are covered in that. So everything that we do or that we'll do is actually covered within the calculator. So the aim of this session is not to replicate or duplicate what's in the solution, but in terms of the thought process, because you'll see that some of the areas or sections that do not form part of the required, those sections are highlighted in red. So as to say to you, whenever you try and practice, you also need to consider, because I know one question might be asking you something, but now you also need to consider perhaps if this question was asked in this manner, how would I have answered that question? Okay. Claudine, please do me a favor if you can mute everyone because I don't have all the functionalities on my side. Okay, cool. Yeah. So that's about it. So we're going to start now. So what I'll do is we will go through the question, all of us together. And I encourage you guys to participate, but I'll be asking questions, but it's going to be very, it's going to be closed-ended question, yes or no, debit or credit, 1 rand or 2 rand, all those kind of things. So I think it will be worthwhile for you guys to participate so that we can see what it is that we know and what it is that you don't know, in order to assist us with the learning and development as far as the module is concerned. Yeah. So what I'll do is, as a start, we'll all read from the same question. But the moment that we're done with reading from the question, then you guys will need to read individually on your own questions, because in front of you, I'll be sharing then the template that I'll be answering this question to. So for now, we'll read together, analyze, and all those kind of things. Because what I always say to students is that if your planning is proper, so you're going to spend much time in planning and then spend less time in writing, because you already know what the scenario is all about. You already know the year that you're dealing with. You already know what is required, what it is that you need to address. So today, one of the things that we're going to do, we'll actually try and see how do we then understand what it is that we need to address. So that is the required part. Okay. So I'll do now, I'll share with you the same question that you should have in front of you. And then we'll just go through and analyze that question. Okay. So this is question 1, and it was with 33 marks, right? Okay. So Chapter Coffee Limited is a company situated in the KZN. The company has a 31st year in December, and that's really important for me, right? Okay, and then the following details are available regarding certain assets, okay, for the company. So on the 1st of November 2010, Choco Coffee Limited placed an order, right, for a coffee machine, for a coffee bean roasting machine from an overseas company for 3,000 euros. Okay, so just by reading only that line, that first line item, I already know in terms of, or you should be able to know in terms of which specific standard that you're dealing with in this regard, right? Yeah. So, but we'll get to that. So the invoice amount is payable on 31st of June 2011. Okay. So 31st of June 2011, it's mid-year or it's interim year because our year end is the 31st of December. So interim is 30th June, and then our year end is 31st December. So the order was shipped free on board on 1st of December 2010. Now, so that wording itself, it triggers something. So if I were you and I see that, I would say, okay, it was shipped free on board. That is when all the risk and rewards are passed now from the seller to the purchaser. That was on the 1st of December 2010. So something in my books needs to happen, right? Okay. And then what is that? So what is the importance of that date as far as that order is concerned? What would you have done, or what does that statement tells you? If you were in an exam, do you need to recognize the machine in your books, or what needs to happen? Only up until free on board on 1st of December 2010. Do you need to recognize anything in your books, or do you just ignore that transaction at all? Okay, so if I were you, as an alarm in my head while I'm busy reading that, I would have said, okay, the risk and rewards have passed on. So that is the date. Then I will for initial recognition, I will recognize the machine in the book. Okay, and the machine was available for use as intended by management. Okay, so this machine, it appears that everything happened on the same day. Because yeah, 1st of December is available for use. It was shipped on free on board on 1st of December, and on the same day it was available for use, right? So that statement assists you in terms of the trigger for depreciation. When should depreciation start? Okay, when it's available for use as intended by management. Okay, but oh, sorry, no, it was only available for use only on 1st of January, sorry. So it was shipped free on board on the 1st of December, and then it only became available for use only on 1st of January 2011. Now, this machine, and then they further say this machine was then brought into use on the 1st of January 2011. Fine. Now you've got available for use, and you've got brought into use. Fine. Now those concepts are two different concepts, right? One is for accounting purposes, which is the available for use, and then the other one is for tax purposes, which is the brought into use. Because if you read the income tax section, that is also one of the requirements, that you must have brought it into use, because it makes no sense that you buy a machinery but you don't bring it into production, or you don't bring it into a working mode to generate income. The purpose that you need to generate you need to do something with it that will generate income. So hence they say it must have been brought into use. Okay. So idle machines, or machines that have been bought and then they do nothing, it would not qualify for an allowance for tax purposes. So that's why those two concepts are very important. Yeah. So the useful life of the machine is estimated to be 10 years with a residual value of 5 million. The residual value and the remaining useful life of the machine, it has remained unchanged. Okay, so that's actually very important for us to know. And then because you bought this machine overseas, or from Italy, so now for that specific transaction, there is applicable dates in between, right? Fine. Now, What I'll do is I'll just share a screen quickly where we analyze those dates, because it's very important that you actually try and plot those dates, right? Just want to share this topic. So in front of you, you should be able to see an Excel sheet, right? So this Excel sheet that I have here in front of you, I've tried to do everything that's given there for you just to analyze what it is that is happening in that scenario, only that part of the scenario itself. Okay. So what I have here is an event in terms of what happened here, right? And then in terms of each event that occurred, I have in terms of when did this event occur, right? Because and then thereafter, in terms of each event that has occurred, what was the applicable exchange rate at that point in time? Because that's very important for you to understand. Right? So we know we've placed an order on the 1st of December. Sorry, 1st of November, right? And at that point in time, the exchange rate was 10.21 cents. So we know at that date there was only an order that was placed, so there was no commitment that took place. So we know that there will be no transaction. So no transaction, no transaction. Okay, so that we know there's nothing that you're going to record during this period of time. So we move on when we say that this machine was now shipped shipped to us on the 1st of December, right? And then here, there needs to be an initial recognition that's going to take place as far as this machine is concerned. So now we're not working with any amounts or anything, but it's just that we're trying to analyze the scenario itself. Now, so we were only going to pay for this machine only in 30th June 2011. That is an interim. But before we even get to interim, right, we know that there is a year end that we need to reach. So from December to 31st of December is going to be our year end. So something needs to happen, right? So in terms of the standard, there's translations that we need to do because we're dealing with a transaction that is presented in a foreign currency. So there's a translation that needs to happen again, and because that debt remains unpaid, so we still owe someone for this machinery because we only pay this machine at interim, right? Fine. Now, so we move on further, and they say on the 1st of January, then this was available for use as intended by management, right? So to me, that is the trigger to say that we can then start depreciating. Okay, fine. And then now here, what's happened is this here is that we also then paid. So here there was a settlement of the debt, or settlement of the creditor, whatever you call it. Yeah, but now the other aspect that you need to take into account is the fact that you will see at each stage of the event, the exchange rate, the exchange rates are different from stages to stages. See, then there is also a trigger that something needs to happen. So it is either we're going to account for exchange differences losses, or we're going to account for exchange differences gain. Because if so, you bought the machine there, right, and you haven't yet paid. If you had to pay during this period here, you would have paid at 10.36, right, which is more than what you would have paid at that point in time, but you did not pay. So you did not pay there, you didn't pay there either. But now, when you pay there, you would have paid less compared to what you would have paid during this time around. Okay, but you will see that when you get to the question itself. But now let's go back now to the scenario again. I'm going to unshare this one and then share the scenario again. Okay, fine. So now we're done analyzing point one. Point two says you had a processing plant. Chocolate Coffee Limited owns the processing plant used for the roasting, grinding, and packaging of the coffee beans. The property was bought on 30th of September, right? So this property was bought in the previous year, which is the 2010 financial year. right, on the 30th of September. Fine. So at the end of the financial year in 2010, how long would you have had this property? At the end of December 2010, how long would you have had this property for? At the end of 31st of December 2010, how long would you have had this property for?
Okay, students, you can unmute your mic now to answer.
Or they can actually type in the meeting chat box.
Or you can type it in the chat.
Yes. Okay, so that's correct. It is 3 months, right? Because the reason I'm asking you, when you come back and answer the question, you will already know how long did you have this this asset. So that's the reason why I'm asking you. So 3 months is correct. Okay. But now you'll see that this property is split between land and is split between buildings. Okay, fine. The property was available for use, the same principle above as intended by management on acquisition date, and was also brought into use the same way above in terms of tax purposes. Fine. A residual value of 500,000, right, was allocated to the building. Okay. Now, if I were to ask you, what was the depreciable amount for this building? What is or what was the depreciable amount for this building? So what I'm asking you is, what is the amount that you would have used in order to be able to calculate what your depreciation is going to be, either per annum or either in terms of a prorated, right? So what is the depreciable? You can type in the meeting chat box, what is the depreciable amount for this property, for the building specifically, because land is not depreciated. So what is the depreciable amount for this for this building? Is the depreciable amount 2 million? Is the depreciable amount 1.5 million? Is the depreciable amount 500,000, or the depreciable amount is 0? Is it 2 million? Is it 1.5? Is it 500,000, or is it 0? So it is 1.5. That's correct. That's your depreciable amount. Okay. And then the useful life of this building is estimated to be 25 years. So on 31st of December 2011, this building was evaluated by an independent appraiser, and then they've determined that this building now is worth 1.250 million. Okay, that's fine. That's where we end. What you know is that we are at cost when you bought this building, but then we know that at the end of the current year, we then had a reevaluation of this building. Okay, fine. Now we move on to the office block. Fine. So in terms of the processing plant, in terms of which standard does this give effect to, or which standard do we need to apply in this regard? We're going to apply IAS 16, that is your property, plant, and equipment. Okay, I'm asking you this because the next scenario or the next part, it then deals with a different standard. And then you're going to see the reason why I'm asking you this, because the question tells you exactly in terms of what is the required asking for, right? Okay. Now we're dealing now with an office block. Chocolate Limited owns an office block. So now they're leasing this office block out to Rich First Limited. Yeah, right? Now if you lease, so if I have a property, I'm leasing this property out. So I'm holding that property for investment purposes, right? Or you can call it can be investment purposes, or it can be for rental purposes. So I don't use this property for my admin purposes. Right? So now I'm letting it out. And then there's a different standard that deals with that, which is IS 40, that deals with investment properties. Investment property one. So this building was bought on the 1st of March, right? 2011 for 1.6. Fine. Now it's broken also down. There's a split: land cost 600,000, and then building also cost R1,000,000. Fine. So we know that at the end of the current year, which is 2011, this building was revalued from 1.6 million to 2.50 million. Okay, and then it's broken down to say land was 700,000, building was 1.350 million. Okay, and then you also so they also give you accounting policies, which is also important to actually read and understand as to how or what are the accounting policies in terms of properties, in terms of machinery, in terms of investment property, and all those kind of things, right? Okay. We can read that in your own. Okay, and then obviously we know already in terms of the depreciation buildings and machinery is provided for according to straight line over the estimated useful lives of the assets. So if you pick if you pick up the, let's say, the integrated report, and then you go into of any company, and then you go into the annual financial statement, even before they start. So after you so it's a balance sheet and then an income statement, then thereafter they will then tell you in terms of what are the policies that are applicable to each specific standard. So it's basically things that they've done, to consider in preparing their annual financial statement. The balance sheet, your statement of financial position, the statement of profit or loss and other comprehensive income, and then a statement of cash flow. So yeah, okay. And then here, so also in terms of SARS, you will then be able to actually understand in terms of what is the wear and tear allowance or capital allowances that the SARS grants in terms of each specific item of PPE, whether it's buildings or whether it's machinery or whether it's whatever it is, right? Fine. So you can read that, and that is, but what's very important is the fact that there is no capital allowances that is granted on admin buildings. So that's very important because there is then an impact in terms of the response you're going to get when you're doing your deferred tax calculation. Because it says SARS does not grant me any allowances for admin building, right? Then it means to me that there will never be deferred tax. Okay, let me not say there will never be. Let me just say, like, for now, what I'm writing here, okay? Because we'll see it actually later that there will be, because as soon as you move above cost, then obviously you will have deferred tax implication. But for now, let's just use this statement here. I'm going to say just for now, but we'll get back to the actual one when you're doing the solution. Because of they're not granting you any allowances. So from if you have from zero up until cost, then you shouldn't have any deferred tax implication in that regard. But as soon as you move from cost and above, then there will be deferred tax implication that's going to arise. Okay, but we'll get there to actually understand what it is that I mean. Okay, deferred tax is provided for on all temporal differences using the statement of financial position approach. And then the company will have sufficient taxable profit in future against which any unused tax can be utilized. So I'm not going to explain this part here because the question itself does not impact us in this regard, right? So I'm not going to explain and confuse you further in terms of what that actually means. So there are no other items causing temporary difference, causing temporary or exempt difference except those that are in the question. Okay, so if you dealt with something in the previous question that you do, don't come and look for it here in this question. If you don't see it, then it's not there, because even the question itself is telling you that only the items that have been identified in the question relates to either temporary or exempt. If you've read something in the other question, then you don't find it here. It's not to say that it should be there, right? So just pay attention to that. Okay. Now, the most important part is to be able to understand what the required is asking you, because it's either you're going to answer what they're asking you to do, or you're not going to answer what they want you to do, right? Fine. And what's very important is Yeah. If they ask you to do journal entries, right, as the required one, and you don't do journal entries, you only end up in calculations. We are unfortunately not going to get any marks, right? So it's very important that you answer what they ask you. If they ask you journal entries, you should be able to have a debit, so your date, your debit, your credit, and then which statement it impacts. Okay, let me just show you what I mean. Or let's first read the required. You need to prepare all the relevant journal entries, cash transactions included, in the accounting records of Coffee Limited to correctly account for the roasting machine. This question is only for the roasting machine. They did not ask you for anything else. This question only relates to the roasting machine, right? And then they give you also an indication in terms of which specific dates that you need to prepare for, right? So it's very nice that they give you the dates, but sometimes they might not give you the dates, right? So you will see what I've done is I would have then added, in my case, I would have added a journal entry further, right? Just for you to be able to see the complete picture of how would the complete question look like. Okay. So what I'm gonna do, I'm gonna show you now what I mentioned in terms of the date, the entry, and then as well as which statement that it impacts. Okay, let me just share this with you quickly. I think it's this one. Share this one. Okay, I just hope you guys can all see what's on the screen, right? So this is how your journal entries look like, but they've already given you the dates in terms of what needs to happen. So you have the date, you have the account that you're going to debit or you're going to credit, in which statement that account impacts. Is it your statement of financial position, or is it your profit? Is it your statement of profit or loss, or is it your other comprehensive income? That's very important. That's very important for you to actually indicate, because at the end of the day, if you have an account here that has no impact in terms of which statement is going to impact, to me it means absolutely nothing, because then your accounting entries or your accounting books then are messed up, right? Because remember, we've got our statement of profit or loss, our statement of financial position, and then as well as our statement of profit or loss and other comprehensive income. So it's very important that you actually need to be able to tell us or to tell the market as to what statement will this impact. Okay. Then let's go back to the question quickly. Okay, fine. Now, what also is important here is to note, ignore all debt implications. So in your journals, I don't want to see, or the marker is not interested to see, tax implications. No journal entry for depreciation is required, right? So they specifically told you that you don't have to do the journal entry for depreciation. In any way, you would not have been able to do, because the required does not include the 31st of December 2011, right? But what I said to you is I am going to show you the complete picture, right? Don't use abbreviations for journal ledger accounts, right? Journal narrations are not required. You need to show all dates for each entry, and then you need to show all the calculations. Okay, so we know required A wants us to do journal entries. They want us to do only for roasting machine, and then as well as we know that they don't want us to do any journal entries that has tax implications. Depreciation is not required. We need to show all calculations. We need to include the dates. That's very important, right? Required to says in using the information in the above journals, right, as well as other information, you will need to disclose the roasting machine as well as the other property, plant, and equipment in the notes to the annual financial statements. And then what they say here, they say in accordance to the requirements of I-16, they say only. So within your note, the marker should not be seeing any items that relates to investment property IAS 16, because that's not part of the requirement. The requirement specifically emphasizes that only IAS 16. Now, IAS 16 items that we know of in this question is only the roasting machine as well as the processing plant, but not the office block. The office block is accounted in terms of IAS 40, which is investment property. Right? Okay. Now, I'm just going to show you quickly the skeleton. So once you've read the required, this is the skeleton that I would have gone back to my exam script and complete that skeleton. I'm going to share that skeleton with you just now. Now, this is the skeleton. So this is the skeleton that I would have done. Okay. It's very important that you also say this note, which entity or which company does it relate to? It's Choco Coffee Limited, right? I am doing the notes for the year ended 31st December 2011. I think what I've omitted here, I'm going to say property, plant, and equipment. Okay, so you need to tell the mark as to who are you doing it for, what is this, which note it relates to. Because remember, in your financial statement, you will have various notes that makes up your statement of financial position, that also makes up your income, your statement of profit and loss, or and other comprehensive income. So this would have been the skeleton that I would have drafted, right? This would have been my skeleton that I would have drafted. But also do not forget about the narrative information that can also earn you easy marks, but we're going to show that to you later on in the question. So I have the machine. So this one would have referred to the roasting machine. I know I have land, and then I have buildings. Okay, fine. Now let's go now to the last required. Is the last required? I think there is. Let's go quickly to the, before we answer the question, let's go to the last required value. Last required value. Okay, so we've done required to 13 marks. That's a lot of marks. And then I'll show you now how you actually get those easy marks, right? Okay, and then you have question number 3. Oh, sorry, required number 3 says you will need to calculate, right? And I'm pausing there because there's a difference. So there's a difference between calculations and disclosure, right? Here, they only ask you to do the calculation, not the disclosure for deferred tax, right? I'm going to show you what the difference is between, or you should know the difference already what is, but I am going to re-emphasize to you as to what the difference is. Sorry, between the what calculate is and disclose the deferred tax, right? When they gave you the specific year, they're saying that 31st of December 2011 using the statement of financial acquisition approach. It's very important because that's the required. You need to use the statement of financial position approach. Then you need to comply with the IAS 12 requirements for income taxes. This is the 11 easy marks that you can get, right? Fine. Now, what I've done is, you will see within my question itself, I tried to do both years for you because I want you to see what the complete picture is. But also in that as well, I've tried to do in terms of what the movement is going to be. But when you practice this question under the exam condition, you just answer what you've been asked. So what I will do within the scenario itself, I will then highlight all those sections that are not part of the required, right? Okay. So what's important is you need to show all calculations and then round to the nearest calculation. Okay. So there were 2 ways how you could have done this question. Or let me say, there would have been 2 ways in my case how I would have done this question, right? I would have either started with required 1, and then from required 1, go and do required 2. With the information that I have in required 2, then I would go and do required 2. Sorry, with the information that I have in required 3, then I would have then use that information to answer required 2, right? The other option that you could do is you can then address everything at once, right? So taking each scenario, let's say roasting machine, addressing roasting machine in this part, addressing roasting machine in this part, and then addressing roasting machine in this part. So the choice was yours, but I think the easier one is to take roasting machine, plot it out in accordance to all the requirements, requirement 1, requirement 2, requirement 3. Then you know you're done with that, then you move on. Then you go to scenario 2. Just want to see what scenario 2 is. Then you go to the processing machine. Then processing machine, processing machine only affects required 2 and required 3. Now we're going to start writing down. Okay, we're going to start writing down. Fine. Now I just want to show you how would the template or how would the skeleton for required 3 would have looked like. So I'm going to share that with you just now. Okay, required 3. Okay, so the skeleton for required 3 would have looked something like this. Right? That would have been your skeleton. But obviously, in my case here, I'm using formulas, so it's easy for me to actually then do it with formulas. But in your case, you would need to then actually write it down. So you will see that sometimes some of the required will then actually want you to indicate whether the balance for that period, whether it's an asset or whether it's a liability, right? So then my indicator here, I would say an asset or it's a liability. Now, a liability I would use that is between brackets, okay? So you can adopt either approach that one, but as long as it's going to be consistent, right? Okay. But remember, so the required is only asking you for this part only, right? So this section that is done in red is to show you what would a complete picture look like, right? So this section here that's in red, it was not part of the required. So this will be a deferred tax calculation, right? So a deferred tax note will be different compared to this. So if they ask you to do a deferred tax note, and then when you only end it here, you're not going to get any marks because the required, let's say in the exam, the required says disclose the deferred tax note, right? In order to get to a deferred tax note, you will then need to do this kind here, right? And then go to a disclosure of that. But now, if you only end here only, you would not have answered the required. But now, in this case, the required then asks you to do the calculation. So you only end at the calculation, which is the balance that they're looking for. Okay, then let's start writing. Fine. Now, you will read now in your individual questions. I'm not going to open the question now. So you will read in your individual question. Okay. So the first requirement was the journal entries. Fine. Now, the journal entries we've already analyzed in terms of what happened, when it happened, when we can start, when was the year end, when was the depreciation, we have to start depreciating, when did you pay this supply, right? So now what's going to happen now is we're then going to start with the journal entries. But let me just open my question here quickly. Just want to see quickly. Okay, so roasting machine, we know it was bought, the order was placed 1st of November, and the order was, so that when they placed the order, right? It was for 3,000 euros, right? Fine. Now, what is the, sorry. So on the 1st of November, is the transaction that we need to record, yes or no? From the 1st of November, from this date, is there a transaction that we need to record to recognize anything or to record anything as far as this order is concerned? There is actually no entry. Oh, but I've already given you the answer yesterday. So there is no entry that we need to record. So on the 1st of December, right? So this item was shipped to a board that is in rewards and now passed from the seller to the buyer, right? So what entry would you have processed in your records to actually indicate this transaction? Which entry would you have recorded in your books to record this transaction? What entry would you debited? What entry would you credited in this case? Okay, you would have debited machinery in which statement? The statement of financial position. You would have credited your trade in other payables or your creditor in your also in your statement of financial position. And how much? And then how much would be that, right? So they've already given you the rate. So I made it easy for you here. On the 1st of December, the rate was 10.03 cents, right? And then we bought that machine for how many? For how much? For 3,000 euros. So you will then say 3,000 multiplied by 10.03 cents, and then you will get how much is your amount that you need to recognize in your book. That's correct, Manzamo. It's 30,090 rand. Fine. Now, remember they said no general narrations are required. You've done the date, you've done the account description, because they said no abbreviations. You've done in terms of which statement it needs to impact, and then we've shown the calculation in terms of how that amount is made up of. Right? Okay. So when did you buy this? We bought this when? 1st of December 2010. Fine. Now I'm going to show you the trick how to get marks back. I have already have what the cost is, right? On the 1st of December 2010. And there's nothing that's stopping me in going into my property, plant and equipment note and then I'll say, I know what the cost is of this item when I bought it on the 1st of December 2010. I know what the cost is, right? Because even now I already know that it was only available for use only on the 1st of January 2010. So I know in this year, there is no depreciation that we need to account for. So I know at 31st of December 2010, I'm sitting at 30,090. That's how you get easy maths. By one amount and then plotting that amount across all the different requirements, right? Fine. But what also would have happened is that, remember I said, if they were to ask you, is my Excel freezing now? I think my Excel is freezing. Okay, let me just do this. Let me just do this quickly. I'm just going to open and reopen it again just now. Not sure why it's doing this. Okay. Where do I open it now? Is that? That is. I'll be with you just now, guys. I'm just trying to sort this out quickly. Hopefully, it's not going to give us a problem throughout the session. Where am I now? Cancel. Okay, I think it's up now. Okay, I think it's up. Just share that with you. Okay, I think there you go now. So what you would have done here would say machine or machinery, whatever it is, because remember you already have the amount, right? And then there's no deferred tax implication because the carrying amount would have been the same as your tax base. So the the temporal difference then is nil, right? Because there is no depreciation taken off at that point in time. You also can't claim any allowances in that case in time because it has not yet been brought into use. Okay, so let's move on. We now go to journal entry number 2. We know that the 31st of December is our year end, right? That's fine, we are year end. Now, we know that there is a translation that we need to do because that debt remains unpaid, right? Fine. Now, if we need to, so okay, let me just go back here quickly. So we recognize this machine at 10 cents, right? Sorry, but now at year end, the exchange rate is 10.36, right? Would you have paid more for this item if you had to pay here, or would you have paid less than what you actually bought it for? Would you have paid more, or would you have paid less? You would have paid more, that is correct. Fine. Now, that's correct, you would have paid more. So, what is the entry that we need to debit here? What is the entry that we need to debit here? What happened now here? So what is the entry that we need to debit here? No, you can't debit machinery because remember you're now dealing with an exchange item, so a translation. Because remember we've already now accounted for machinery in the first entry, right? So your answer, you said you would pay more, right? So I would expect that there would be an exchange loss, exchange difference, and then I would say loss, and then I would say here my trade, creditor, trade, and other payables. Okay, right. And then here, where would that go in your profit or loss? And then where would that go? Would you go into your financial position? And then how much is the amount? Right, fine. So that's correct. Trade other payables. So remember, you still bought it. So the debt that remains outstanding is 3,000 euros, right? Now, that's what you've used to recognize initially, and then now at the end, that debt would have been worth that much, or you would have paid that amount if you had to pay, right? Fine. Now, so you would have said, how much, what is the exchange rate currently, and then how much I've recognized this for in my books, right? And then you would get an answer of, why is it not? I'll just reopen again. I'm sorry about this. I have challenges with Excel. Okay, so that is the amount that then you would have recognized as your exchange loss or as your exchange difference, right? Right. Now then we know that on the 31st of sorry, not 31st. So obviously on the 1st of January, then we can then start depreciating this machinery, right? On the 30th of June 2011, we then had to settle this debt. Right? But now, so we then have to settle this debt. Right? So now we need to record how much you would have settled this debt with, right? So what I would have done is I would have then debited my trade and other payables because that's how much my creditor is my foreign credit is gonna decrease with, and then obviously I would have paid cash, right? And then that will be in my statement of financial position, the same as that one, statement of financial position. How much will be that? So at that point in time, the exchange rate is 10.29 cents, right? Let me just say, just in case it doesn't. So my exchange rate is 10 rand 29 cents. I still owe them 3,000 euros, right? So that's how much I would have then settled my debt with. Okay, fine. Now there's also something then that also happened in this regard, right? If you go into your scenario, then you would have seen that from year end up until when you then settle that debt, the rates of exchange are different, right? So at year end, that debt will, if you pay that debt at that time, it would have been sitting at 10 rand 36 cents. And then if now when this debt was settled, this debt was only then settled at 10 rand 29 cents, right? Okay, meaning that now there's now an exchange gain. Okay. What we do is now here we'll say trade and other payables, right? And then here we have an exchange gain, exchange difference. Let's say okay. Where will that go? Statement of financial position. And then where will this go in your profit or loss? Okay, we know how much you owe them, and then you know what is the difference between. Okay, so that's how much it would have. So that's how your entry would have looked like, right? So you see that we gave effect into the requirements. Say what we've given the dates, we've given the account description, and we also give in terms of what accounts we affected, and then we've showed all our calculations in terms of how we get to those amounts. But then remember what I said to you that everything was not part of the required. I'm gonna do it in red, right? Because the reason why I'm doing this is because you will see when you get here, you will need that depreciation amount. So that's the reason why I'm saying to you that even though it's not required some of them, but you actually need to do them, but you can do them on the side as your calculation, right? Fine. Go back to your question quickly. If I remember your question, I don't have the question now because I closed the screen. So the question I think they would have asked you, they would have indicated to you that the residual value for this vehicle would have been, I think, 5,000 rand. I think that would have been the residual value. So your depreciable amount is what your cost is versus what you can get for this vehicle at the end of its useful life, which is your residual value. Then your depreciable amount is going to be 25,095. Now remember what you said. That this machinery was then available for use when, let me just check. Okay. So this machinery was then only available for use to 2011. So this machinery, or let me say depreciation per annum, rather, per annum. So this machinery was only available for use as intended by management only on the 1st of January 2011, right? So that's why in our property, plant and equipment note there, we don't have any depreciation, right? But now in the current year, I will just for the purpose of the exercise, I will say current year, right? You don't have to don't do that in your solution. So I'm saying this deals with the current year, right? So current year, I would say I've already determined as to what is the depreciation per annum, right? The depreciable amount, right? And then I know that depreciation on on machinery is 10 years. That's a useful life, 10 years. So 25,019, and then you divide by 10 years, days of 10 years, it gives you 2,509 per annum, right? So I would have debited, if this was part of the required for the entries, I would have debited depreciation, and then I would have credited what? Accumulated depreciation. Okay, And then where would I debit this in my profit or loss? And then where would I credit this in my statement of financial position? So I've already had the amount there because I'm using Excel, but it's exactly the same as what I've actually calculated because that amount comes in, right? Fine. Now, another trick would then be you go directly to your disclosure note, right? You have what the depreciation is, right? And then your carrying amount at the end would be that minus that, you would get your carrying amount. And then this recon is important also for easy maths. Say what was the gross amount, right? Which is that because there was no depreciation accounted for in the previous year. What was the cumulative depreciation and impairment loss? So in this case, you want an impairment loss, but there will be a question whereby you might have impairment loss, right? And then you consider that also as part of this section. So now you are done with your roasting machine, right? The only part that perhaps you would have forgotten with the roasting machine is to say, how would the deferred tax implication look like for this machine, right? How would the deferred tax implication look like for this machine? Or my question is, if I can ask you, do we need to consider any deferred tax implication as far as this machinery is concerned? Do we need to consider any deferred tax implication as far as the machinery is concerned? Yes or no? Do we need to consider any deferred tax implication for this machinery? Yes or no? Okay, so we need to, right? Because for accounting purposes, we've got a depreciation rate that's giving us 10 years, and then for tax purposes, the depreciation rate or the wear and tear that they're granting us is different compared to what they're giving us. Okay, there was a hand up.
Yes, Tolani, sorry. Can I just double check with the depreciation, the 2,509? It said the machinery was brought into use on the
Yes.
1st of. So are
On
we
the
calculating from 1st of January up until December? Is it 12 months or is it 10 months?
Okay, I'm going to answer this. I'm going to answer you just now. Okay. Now, remember when we bought the machine on. Let me just check the question quickly. Let me just put the question. So we bought. So then the machine was shipped free on board on the 1st of December, right? However, the machine was only available for use only on the 1st of January. So from the 1st of December 2010 up until 31st of December, which is the prior year, that machine was not available for use at that time. So there would not have been any depreciation journal entry that you are required to process, right? The only time that you will start depreciating is when the item was available for use as intended by management. When was this available for use as intended by management? It was only on the 1st of January 2011. Now that is the 2011 financial year, not 2010. So that is the reason why you would not have to account for depreciation in the 2010, but in the 2011 financial year. So hence you will see that my journal entry date here is the 31st December 2011 and not 2010 because we could not claim or we could not write off any depreciation in that regard. So that's the reason why we cannot account for depreciation for the 2010 financial year. Okay. Now, let's go to the deferred tax entry. How would the deferred tax entry? So, as you are right, you will need to consider deferred tax implication for this machinery. Now, remember I said to you, this section was not required. That's why I've done it in red. It was not required, but I'm trying to show you the complete picture. So what would have happened is that, okay, so that's machinery, your carrying amount, you've already determined is 30,090 and your tax base. But because of it was not available for use and it was not brought into use on the 31st of December 2010, then we can't claim any depreciation or any allowances in that regard, both for accounting and for tax purposes, right? So then there's no deferred tax implication. However, for 2011, in your solution for 2011, you say machinery was 30,000. We've already done here. So it's a matter of copying and paste. So so the carrying amount of the machinery is sitting at 27,581. So there it is. But now the challenge then will be, I haven't yet determined as to what the deferred tax is going to be, or sorry, what the tax base is going to be at the end, right? Fine. So I made it easy for you. Made it easy for you. Fine. What I'm saying is, you have the cost you're getting from there, right? And then your referencing must say, where do you get that cost from? And I'm saying it comes from journal entry number 1, right? We know what the wear and tear is. The wear and tear is usage of over 6 years. That's what your question is telling you. So if you go to page, if you go to under taxation, where they says SARS, South African normal tax rate is 28%, and then CGT is inclusion rate is 80%. If you go to the bullet number 2 under taxation, you will see that in terms of section 11E, SARS is giving us 6 years as a write-off period, and then we need to apportion as part of the year. So that's where that comes from. And then my tax base in 2011 would have been how much? Would have been 25,075. Right. Now, before I move on, so now we are done with roasting machine. Roasting machine, we've done journal entries. Roasting machine, we've disclosed it in the note. Roasting machine, we've accounted for deferred tax implication. So all the marks that we were sitting with roasting machine, you would have accumulated those marks, right? Before I move on to the next question, is everyone fine with roasting machine? Before we move on to something else, is everyone fine with roasting machine? Okay, I assume everyone is fine with roasting machine. Fine. Now, what we're going to do again now, we're going to take now the processing plant. We're going to take the processing plant and then follow the same step to say the processing plant, we're going to go and plot in here in your disclosure note, and then plot in my deferred tax, deferred tax, right? So the moment you're done doing calculation, you must go and plot. Okay. Now we're gonna do the processing plan. I will assume that you have read the processing plan, you've understood what's going there, because I've read the processing plan and I've understood what's going there. Just to summarize it for you, the processing plant had land and had buildings, right? So now this is the question that I've taken up with myself and then summarize it, because I can't have 2 screens in front of me, right? But you don't do this in the exams. This is only for my purposes here, because I don't have the question in front of me, right? So I know this was bought the 30th of September, right? And then I know that in the 30th of December 2011, there was a revaluation that was done, right? That information I have. Okay, but then I know that I can also consider whether there is deferred tax implication, meaning that now the depreciation rate that we have for accounting purposes is different in terms of what the wear and tear is for tax purposes. Right. Right. So what was the cost for this building? The cost for this building was 2,000. Right. That's what this building. Cost us. This building costed us 2,000, right? But then we know now that in this building that cost us 2,000, we had a residual value of 500,000. What I'm trying to do now, I'm trying to then determine as to what would have been your depreciable amount, right? Your depreciable amount would have been 1.5 million, right? We know that this item, we bought it for how much? Sorry, when did we bought it? On the 30th of September 2010. And then in the current year, how long did we have this building for? In the current year, how many months or how long did we have this building for? In the current period, sorry, in the at 31st December 2010, how long did we have this building for? 30th December 2010, how long did you have this building for? Okay, so my question is, that's when you bought the building, right? Now I'm asking at the 31st of December 2012, how long would you have the building for? 3 months is correct. So it would have been October, November, and December, right? It means that now in 2010, we would only need to account for depreciation for only 3 months, right? We have our depreciable amount, and then we need to determine as to how much would the depreciation be for 3 months. So what you're going to do, you would take your depreciable amount and then you multiply by what is the rate again? Is it 10 years or 20 years? I think it's 20 years. Just check quickly. Sorry, it's 25 years. So you would have said it's 25 years. Yes, it's correct. You would have said depreciable amount. Sorry. The depreciable amount, and then over 25 years, right? And then you only accounted for 3 over 12 months, because in 2010 you only had it for 3 months. So that's how I got to that 15,000, right? Fine. Then obviously now what's important that you also need to do, you would then your yearly depreciation would then be, so you would take your depreciable amount, then you divide by 25 years. So your yearly depreciation, it would then be 60,000. So there it is, I have it there, right? Fine. Now, you know what it costed you. You know what the depreciation was for 2010. You know what your depreciation per annum is, right? So there's nothing that stops you to go and determine as to what is the carrying amount in 2010, what is the carrying amount in 2011. Now, if I were you, I have two choices. It's either I go to my property, plant, and equipment note, or I go into my deferred tax balance, right? Where is the business? So I bought it for 2 million. There it was, 2 million. And then I know what my depreciation is because I've transferred it directly to there. So my carrying amount is 1985. If you go to this calculator, there is my carrying amount, right? Fine. I know that there were no revaluations in the building for the current year. It only relates to land. For building, there was nothing in the current year. Fine. I know my depreciation per annum, as I calculated here, is 60K. Fine. Then I know what my carrying amount is. And then this recon as well is very important, right? Because whatever that you have here, it needs to agree with your carrying amount in the current year, right? Fine. We'll get to this inherent information later on in the question. Fine. Now you've done doing it in the disclosure. Now you need to go and do it where? In your deferred tax calculation, right? So you'll see here I've made a distinction between your processing plant and your office block. Fine. Now, so I'm gonna say is that machinery or land? Sorry, it's building. Fine. It's building. So the reason why then you see amounts, because I'm using Excel, so obviously I have formulas that pulls through, right? But now my carrying amount, I would have copied that directly. We have done the calculation, and then as well as now the issue now is my tax base, right? Fine. Let's go to the tax base. Fine. I know what it cost me. It's 2 million, right? We already have it here. I know how much they're granting me for buildings, right? It's 5% per annum, right? So my wear and tear per annum is how much? Is 100,000. So I will get that is going to say your 2 million times the 5% annual allowance that they give me, it gives me 100,000. So there is 100,000, right? Then I already know, so there is the 2 million that comes there. There is the 100,000 as your annual allowance, and then your carrying amount for tax purposes would have been 1.9, right? And then in 2010 would have been 1.8. There it is, 1.8, fine. Now, obviously, here you would have a liability, right? And then here you would also have a liability, fine. But then we are not done with the roasting machine because remember, sorry, so we're not done with the processing plant because the processing plant was made up of two things. There was land, there was building. We've only addressed building now. There is then another aspect that we need to address. It's going to be land. Right? It's going to be land. What was the cost for land? Give me the figure quickly. I don't have the question in front of me. I don't think I remember correctly. What was the figure? What was the cost for land? I think land was R1 million. Land was R1 million. Million rand. 1, 2, 3, 4, 6. Okay, that was land, and then there's no tax base for land. Okay, fine. Now, so land would have been an exempt item because remember, there is no allowance granted in terms of land. Then therefore there would not have been, so it's a permanent difference, right? So it would not have been a temporary difference, but a permanent difference. Fine. Now, is that the only thing that we need to do for land? Correct? It's $1 million or more, correct? We see what million. Now, is there something else that we need to consider as far as the land is concerned for deferred tax purposes? Why are you guys saying no? Because remember, if I remember the question correctly, it says that on the 31st of December 2011, we have done a revaluation, or it was revalued, or it was valued, whatever amount, whatever terminology that you use. Right. So the land was then at 31st of December 2011 was now sitting at 1.250 million. But we know that that's not true because initially it was for 1 million. So it means that between the cost of $1 million and the revalued amount of $1 million, something happened. That was revaluation, right? So you have an option. Okay, not an option. Let's do this fine. So we say land, and I say revalued amount, right? So how much is that amount? That amount is 250,000, right? Okay, because remember we said from zero, so from zero to cost, it becomes a permanent difference. But anything above cost, then it's going to be, then that creates then a temporary difference or deferred tax implication that you need to account for. So, but now remember what's key is, so at what rate do we need to account for our temporary differences for? Do we account it for at 28%, or do we need to include the inclusion rate of, do we need to include the inclusion rate of CGT at 80%? Because remember, land, the cost for land or the value for land is going to be recovered through sale, right? So then when you account for deferred tax, we then need to reflect the manner that we're going to recover that value or that cost or that amount. Okay. So are we going to include the inclusion rate here or not? Okay. So we will include, so our temporary differences will need to reflect it at an inclusion rate of 80%. Right? Fine. So therefore, not the full 80,000 is going to be reflected as a future liability, right? Only 80% of that amount, because remember when you sell the property, the CGT that we're going to have to account, or we need to indicate or reflect in our tax returns, is only going to be at 80%. Fine. Okay, and then, so that will be the liability of 56,000. Okay, I think someone has a question.
Yes, I just want to ask if they don't mention anything about the revaluation, I mean about the subsequent method, whether it's cost model or it's a revaluation method. If they give me a revaluation value of the land, must I assume that they are taking a revaluation method as a subsequent measurement?
My understanding is they will always give you that accounting policy. Because remember, whatever that happens, it needs to, whatever that you do in your books, it needs to speak to what your accounting policy is saying. So I think the accounting policy in terms of what land is accounted for, or what buildings are accounted at, whether it's cost or revaluation method, they will always give you that. So it's not going to be a guessing game in terms of what is the method that's used in this regard. So they will always give you that one. Because remember, it's an accounting policy. So in order for you to be able to know what it is that you need to do, whether in terms of your disclosure note or whether in terms of the deferred tax purposes, they will then need to tell you the method that they've actually used. Like currently how they've done in the question, giving us an extract from our accounting policy to say, how is land accounted for? How are building accounted for in terms of which model they're giving us? So that one they will always tell you. And I think I've seen in all the questions that they actually give you that information. So you don't need to guess in terms of what model it is that they're using to account for buildings or to account for land or to account for investment property. Okay, fine. So let's continue. So now what we're missing now is to do the disclosure note as far as land is concerned. So we know land, there was no depreciation or accumulated. Let me just remove that part there, or accumulated impairment loss. Right? So we know building cost us $1 million, and then during the current year, we only had revaluation of 250, and then at the year end, our revalued amount or our recent amount is going to be 1 to 50. Therefore, the gross amount needs to be 1.250 million, right? So remember, we've done this now. We've addressed now machine and we have addressed land in terms of now all the requirements. So the only one that's still remaining in this regard, which will be able to do it in like quick, easy step, 5 minutes, it's the building part, right? So this is a nice way in terms of how you get your marks easy, rather than now doing one required and then reading everything and then doing the second required and then having to go back and reread all the information, right? So here you take one scenario, you address it here, you address it in your deferred tax, and then you address it also in your journal entries, right? So you're trying to avoid having to go back to the scenario each and every time that you do a question. Because remember, we've done roasting machine once, and then we never went back to it. And then we've done also the processing plant of building once, we've never went back to it. We've done land once, we've never went back to it. What am I talking about? Yeah, so we've done land and everything. So we're now done with the roasting machine, right? But so your disclosure note now is complete as it is, right? However, if you go back to your question, right, and then you go to required 3 or required C, required 3. Now, required 3 says to you that you will need to calculate, right, the deferred tax balance in the statement of financial position of Choco Coffee Limited as at 31st December 2011, using the statement of financial position approach, right? They did not say that you only need to do for roasting and for the processing plant. This means that our deferred tax calc, right, is missing for the office block. Are we together? So what I'm saying is the question, and I think that's a mistake that some students make. The question did not say only do for roasting and processing. The question said you will need to calculate the deferred tax balance. There were no specific items that there was no specific class of PPE that they referred to. My assumption is if there is no specific item that is required, then you will need to account for all of them, because even, sorry, the mark allocation needs to guide you, right? And then in this case, our question is missing the office block. That's what is missing. So now we're going to do the office block. Fine. So in summarizing for myself, I know I bought this machine, or sorry, I bought this. So this building I bought it in 2011, and then obviously leased it out during that period. I know that there is no depreciation in terms of the standard. There is no depreciation that I'm going to account for this office block because I'm renting it out. Right? They've given us the accounting policy for buildings. Fine. Now we know we are dealing with the 31st of December 2011. Right? Fine. Now, if you go to the question, in the question you would have been able, you would have seen that the same as the office block, it was splitted between land and building. Right? So your land would have cost you, I think, 600,000. Right? 600,000, and then your buildings would have costed you, I think, R1 million. And because altogether it was a million, it was 1.6 altogether. So it would have costed you a million rand. Fine. Now, there is no, you are not required to disclose that in here because that was not part of the required. Right? Your required number 2 only said roasting machine and processing plant. So we are done with this part. But our deferred tax did not limit us to roasting machine and processing plant. So we also need to account for office building. Building. Fine. Now the cost was 600,000 for land. Land was okay, but then remember, okay, so in here it would be no, right? Because we've only bought this property when in the current year. What am I doing now? Okay, we bought this property when in the current year. So your values for whether your tax base or whether your carrying amount for land building, it would have been how much? It would have been nil, because at that year you did not have that item of investment property, right? What are you doing now here? Okay, fine. Now, okay, fine. That's landed cost. So that's office block, and then here is, am I forgetting something here? So I have machine, I have land, I have building, and then I have the land cost. What do I have here? Okay, that's fine. Okay, fine. Now, so the land that you bought here, the cost would have been 600,000, right? Fine. And then remember, we said that this from zero to cost, then this will be a permanent difference because there is no sort of wear and tear that's allowed. Fine. But now, the moment you move above cost, then you will have to recognize deferred tax implications, right? What you know is that the office block is that office block was then revalued, right? How much was the office block? Sorry, how much was the land revalued with at 31st of December 2011? Land was revalued to 700,000. Right? Then it means that above the cost that you need to create or that you need to recognize deferred tax implication on, it's only 100,000. So we say land revalued amount, or whatever you call it. It's going to be 100,000. But then remember, we said we then need to recognize this at the so we need to show the manner of recovery. So the manner of recovery for the value for the cost of the land will then be through sale. So we need to reflect it at CGT inclusion rate. Okay. So that would have been a feature, that would have been a liability. Fine. Now we're done with land. There's only now one item that is remaining. And what is that item? That item is land. Sorry, so that item is building. Now the manner of recovery for building is going to be through sale. I think also the fact that there is no wear and tear allowance that is also being given is also an indication, right? Because if you saw in the question that this building is used or is leased out to, I can't remember that name is, so it's kept or is used for rental purposes, right? Fine. So I do have what the cost of the building was. Right, building cost me 1 million. So the same principle that you apply, that from zero to cost, there is no deferred tax implications that we need to account for. But as soon as we move above cost, then we'll then need to take the deferred tax implication. Right? So building, let's say revalued amount. Okay, fine. So how much is the revalued amount of the office block? So initially the building cost, initially the building was R1 million, but now in terms of the valuation that was done, the building was sitting at, is it 1,350 or 150? Let's check quickly. The building was sitting at 1,350 million, right? So we've revalued the building worth 350,000 rand, right? So there is a building 350, that amount is taxable at the current prevailing CGT rate inclusion. So let me just say, so the temporary differences that we need to raise is at the prevailing CGT rate of 80%, right? And then there is our liability, right? Fine. So the question what it asked for this balance here. That was what the question asked you. So I would have expected you, once to get to that amount, then you stop, right? But I was trying to show you what the complete picture would look like, right? Because through these sessions, I want you to have a bigger picture, right? So now within the 1 minute or 2 minutes that's remaining, there is the question perhaps would have also asked you to do the movement temporary difference, right? So you started with 23,800 as your liability, right? And then you ended up with a liability of 192,502. What would have been your movement in that regard, right? So you would say X, let's say, plus, okay, it's not going to work this way. Because I don't need. So you're going to say X is unknown, and then you're going to say Y is going to be 1 minus that. That's going to be a Y. That's going to be my Y. No, I'm talking nonsense, sorry. The Y is going to be that. And then my Z, so my Z is going to be right. Okay. Let me just open Word quickly just to show you how easy, because you don't have Excel. So just gonna share my Word with you quickly now, just to see, because now here we're using the mathematical calculation here. Just gonna share quickly the Word with you and then do it together. Fine. So we will say X plus Y is equal to Z. Okay, and then we already know what Y is. So Y plus negative 23,800, okay, is equal to negative 192 FAC3702, okay? And then now what we're going to do, we're going to make X the subject, right? So you're going to make X the subject, so you're going to say minus, so minus 92, minus 92, and then now we're going to move this 23 over to here, so that negative now becomes a positive. So it's going to be positive 23,800, and then you should get an answer of, so X is equal to, I think 168 something is equal to negative 168 702, right? So that's how you do your movement, right? So you always make X the unknown, right? X is the unknown, and then Y is what you started with in the beginning of the year, which was your opening balance 23,800, right? And then your Z is what you've ended up with, which is the balance at the end of the current year. Then you do that mathematical equation, right? Yes. So, and I think that's about it. But so if you see, we spent more time doing the planning, right? And we spent less time writing, because if I remember correctly, I think we only wrote for 30 or 40 minutes, if I remember correctly. And then that's how it's supposed to be, because we've read the scenario, we've understood the question, we know what is that expected of us, right? And that's how you actually then approach the question. Because if you're looking at it, you've also done what was not required, even within the time frame that we're doing this question. So yeah, and I think, yeah, so I think that's about it. If there are no questions in this regard,
X.
yeah, I think that's about it.
Sorry.
Yes.
Just an appeal, please, for them to complete the attendance and the evaluation. I can only see on the Excel sheet that gives us the output. Only 2 people have completed the attendance, and there's 8 people in the class. If they can please just, I know it's admin and they were listening to you, but please, we need the attendance. Okay, thank you. They say they're busy with it. Thank you very much.
Okay. So thanks, Cody. So thank you, guys. We'll then see each other in the next session. So you can just have a look in your at your working schedule or timetable.
The schedule was in the email that was sent to them. The full schedule.
Okay.
For the semester. Okay.
Okay, cool. Thanks, Claudine. So
I'll stop the recording now. Okay.
Okay. Thanks, Claudine. Cheers.
Okay.
Bye. Bye.